Good afternoon, everyone. Pleasure to be here. As Tom mentioned, the big news for our company came out last week with the announcement of a 1 billion Canadian dollar project financing package. I'm going to go into the details on that near the end of the presentation, but first I'll walk through the sort of an overview of the company for those who maybe aren't so familiar with Skeena. Skeena is focused on developing a precious metal mine in the western part of Canada, up in the Golden Triangle of British Columbia. We call it the revitalization of Eskay Creek because this project was a legendary underground mine that operated from 1994 till 2008. We optioned it and acquired it from Barrick in 2017. We also have another smaller deposit, another former past-producing underground mine called Skeena, called Snip, which again we optioned and acquired from Barrick. I'm going to talk about two people in the management team that are relevant to this stage in the company's evolution. The first is our CEO, Randy Reichert. I recruited Randy from B2 Gold, where he was senior vice president of capital projects. Obviously, we're about to build a mine. We need someone who has mine building experience, and we have that in Randy as the CEO. Second person I want to mention is Naylene Morin. She's our VP of Sustainability. Naylene joined the company about 2 years ago. She came to us from the Tahltan Central Government, where she spent the last 12 years of her career. She is Tahltan, and she was responsible for the permitting of projects in Tahltan territory from the First Nations government perspective. So we're very fortunate to have her in charge of permitting Eskay Creek for us now. She's tremendous, obviously, relationships with her colleagues in the Tahltan central government and also in the regulatory side of the provincial government. We have a large land package here, but one of the biggest advantages of this project is, of course, it's a brownfield project. So we have roads already built. The biggest stroke of good luck came after Eskay was shut down. Another company came in and built 3 run-of-river hydroelectric facilities right next to Eskay. So we're 17 kilometers from connecting into one of those hydroelectrical generating facilities, and it's a game changer for Eskay in terms of operating cost. When Eskay operated in the 1990s and 2000s, if oil prices ran up to 80 or $100 a barrel, energy was represented as much as 50% of the operating cost. Now with hydroelectric, energy will be less than 5% of our operating costs, so game changer. I mentioned the legend of Eskay, and this is it. This small underground mine produced 3.3 million ounces of gold and 160 million ounces of silver, but it's really the grade that sets it apart. For every ton of production, there was 45 grams of gold and 2,200 grams of silver. So on a gold equivalent basis, you're almost 2 ounces per ton. I mean, who's ever heard of anything like that? It's incredible. The idea we had for going after this asset was obviously it was such a high grade mine. You know, could we look at this in a different angle as an open pit, knowing we had cheap power nearby? Could we revitalize this? And the answer is yes. This is what we've come up with on reserve so far. We've got 3.3 million ounces of gold, same amount they mined historically, and 88 million ounces of silver. The gold equivalent grade for this open pit is 3.6 grams per ton. So super attractive grade for an open pit. And that translates into economics. And you can see we did a feasibility study that we released back in November at $1,800 gold. Numbers look great, but it's amazing. You know, gold prices have gone up a lot, silver prices have gone up a lot. So now we're sort of in this third box here, and using $2,300 gold, $29 silver, we've got a 57% after-tax IRR. This is a project that will generate 500 million Canadian dollars a year of after-tax cash flow. It's got a payback on capital of less than a year. I mean, truly robust economics. You can see on the bottom here, the project will do 260,000 ounces a year of gold, almost 8 million ounces a year of silver. So it's going to produce about 1% of the world's silver mine production. All-in sustainable cost, $687 US per ounce gold equivalent. Again, when the Barricks and the Newmonts are producing gold at $1,300 or $1,400 all-in sustainable cost, this is way down on the cost curve. And CapEx pretty manageable, 700 million Canadian dollars. Right now, the mine life is, the production profile is much more weighted to the first 5 years than the second half of the mine life. We fully expect to backfill the second half of the mine life with better grade material. For instance, Snip is not included in our mine plan at all, and that's got about 1 million ounces at 9 grams. For the purposes of going through permitting, we have to leave that out for right now, but as soon as we get permitted, we'll start to be able to bring in some of these other opportunities and backfill the second half of the mine life. Also, something that's not in our feasibility study are some of the other metals that we have. We've got a huge amount of antimony. It's a critical metal. My understanding is the U.S. Department of Defense is quite eager to find supply of this metal. I think it's like 10% of the world's antimony supply could come out of this. The problem right now is no processing capacity. It's all in China, Tajikistan, and I think Russia. So when we talk about these critical metal problems, we have it, but where do we get it processed other than our, the smelters in China? Smelters in China, I'd also add, are all over us because of the silver content that we have in our concentrate. There are perceived shortages on access to silver for solar panel manufacturing. We've also got a lot of zinc and just a little bit of copper. That's what the open pit's going to look like. A small processing plant over on the side. One thing I'd mention, because it's a brownfield project, we have a fully permitted and ready to go tailings facility that Barrick created for us. Just in the interest of time, skip through. This just shows production versus grade. Eskay stands out amongst projects globally. One thing I want to highlight on this particular slide is the underground potential. Like, we've only highlighted the open pit potential of this project. This is, again, an opportunity for us to extend the mine life by adding an underground component to it later. We just haven't had time to get to that yet. We're also doing exploration, trying to follow the down dip of this original deposit that had such a legendary high grade. They mined out the super high grade, where our open pit will grab the remnant material that was much lower grade. But we think there is still the opportunity to find out what happened to that horizon that just suddenly stopped when Barrick was mining it. I had Barrick geos, say to me, if we could figure out what happened, where did that potentially continue? And that's something we're looking for. We're doing seismic this summer to try to help our exploration targeting. I mentioned Snip, satellite deposit that's out there, almost 1 million ounces at 9 grams. We'll try to bring this in. One of the things we've been working on the last couple of years is expanding our land package. You can see in 2012 we had 2021 we had 12,000 hectares. 3 years later, we're approaching 200,000 hectares. Our idea is real estate is super valuable in this area, and we're now the third largest property owner up here after Newmont, Teck, and then Skeena. This is the money slide right here. I mean, everybody's seen this evolution of a junior mining stock. If I showed you, one thing I have to do is I need to add our actual stock price to this chart, because it's following. We before we announced sort of finding all that material at Eskay, our share price was like $1. It went to $17, and then it went all the way back down to $4.80. And now we've completed the DFS. We just announced project financing. We're starting to move up. We're now at $7 and I think 30 cents as of Friday. And so my expectation is, as we hit these major de-risking milestones coming up, the impact benefit agreement with the Taltan this fall, completing all of our permits, which take another 12 or so months, get through construction, and we can move our price to NAV from, actually we're sort of 0.25 price to NAV right now, and in production we could be closer to 1. The other point we haven't done a good enough job of emphasizing is that silver is a huge part of our mine, and silver companies get a premium price to NAV versus gold companies. I think gold producers are averaging around 0.8 times price to NAV, and silver companies are around 1.4 times price to NAV. So this, I call it the money slide because it tells you how much more our stock price can go up from here. Okay, let's talk about briefly our financing package that we announced last week. 1 billion Canadian dollars. It's with Orion, 750 million US. It more than exceeds our capex of 700 million Canadian. There were 3 things I was looking for in this financing package. The first was certainty of funding. The second was flexibility for Skeena. And the third was to maintain as much optionality as we could for Skeena. And you're going to see how we manage that in in the various components here. Let's start with the equity. We got a commitment for 100 million US from Orion. That solved a problem for us and that we didn't need to go out to the broader capital markets to raise the money. There were some other proposals that we had that were of the same sort of quantum, $1 billion plus, but those other packages had a contingent requirement that we go raise 50 or 75 million in the broader capital markets. And the last couple times we've raised money through bank-led financings, mysteriously our share price declines in the 2 or 3 weeks before we launch the deal. Then the institutional investors demand a discount to market, usually 7 or 8%, and then we pay the banks 5% underwriting fee. So there's a lot of friction when you use the traditional Canadian sort of capital markets for raising money. Instead here, Orion gave us a premium to our share price. Last Monday, our share price was, I think it was $6.20. So we got Ryan to come in 2 pieces. One piece was $8.32, and the other one was $6.65. So we got a healthy premium to market. We didn't pay any fees to any banks at all. And we crossed off that, or checked that box on the equity component is fully subscribed and done. Then we move into the gold stream. And I think there was initially some criticism on this financing package that the gold stream was expensive. And it certainly is if you compare it to a typical Franco-Nevada or Wheaton stream, which, the headline number will be the cost of capital is like 5 or 6%. And our cost of capital on this is around 12. So why did we choose a more expensive choice of how to do our stream? Well, the answer is Wheaton and Franco don't generally allow you to buy back a meaningful amount of your stream. In this case, we're able to buy back 2/3 of our stream at an 18% IRR. So I like this sort of dynamic because it creates an asymmetric outcome. If the price of gold goes down, we leave the stream in place. If the price of gold goes running higher, we've capped the return for Orion at 18%, and our shareholders are able to maintain all that optionality on gold prices that go higher. The other thing that we instituted was an area of interest that's 500 meters around the existing deposit. Most streamers, they're looking to make their money 2 ways: a run-up in the commodity price and exploration success that extends the mine life. By drawing a circle of 500 meters around our existing reserves and excluding that 178,000 hectares of exploration land, we're maintaining that exploration upside for our shareholders. Last 2 pieces here, the senior secured loan and the cost overrun facility, $450 million. We pay 1% a year standby fee to maintain that commitment of funding available to us. However, there is no break fee. We can walk away from that at any time. So if at some point over the next 18 months we find a cheaper source of debt financing, we can replace this piece with no penalties at all. And so, bring this back to the original themes I was trying to get with certainty of funding. So we have that with this committed debt and cost overrun facility, but we kept the flexibility and optionality that if Skeena finds another source of capital, we're free to go do that. Last point I'd mention about this whole package is it's structured in a way that doesn't impair our company or the asset from the perspective of M&A. If Skeena were to be acquired by somebody, they're not having to pay these huge penalties to get out of this financing package. So that was really important to us as a company that we like to be nimble and innovative, and I think we accomplished that with this package. We've got lots of equity research coverage on our company. I think we're at a really critical moment where we're on the launching pad on the second hump of that Lassonde curve. And so I hope you guys go buy our stock. Thanks so much.